All right, LinkedIn, Vivek Joshi here, and let's dive straight in. You're building something impactful, right? But every great vision needs fuel capital. Welcome to our deep dive into the world of venture funding. No complex theories, just the practical, actionable truth you need to navigate this critical path and get your business properly funded. We're talking real talk, no fluff. So you can actually get out there and do something with this information. Today we'll decode the various stages of funding, from pre-seed to mezzanine, and the key criteria investors look for at each stage. This isn't just academic, it's the real-world playbook. Understanding these investor expectations at each step is absolutely crucial. It means you're not guessing, you're operating with intelligence, saving you time and increasing your odds of actually getting that check. Stop wasting your breath on investors who aren't right for your stage. So if you're serious about scaling and securing investment, pay close attention. We're breaking down what investors want to see beyond the surface level pitch. This is about empowering you to build a compelling case, to walk into those rooms with confidence because you know what matters. Your execution matters, and it starts with understanding. Let's get to it. All right, pre-seed. This is where the magic starts, but let me tell you, it's raw. You've got that idea burning a hole in your brain, that thing you can't stop thinking about. But here's the hard truth. Ideas are cheap. Execution is everything. At this stage, investors aren't just looking at your PowerPoint, they're digging into the problem. Is it a real, painful problem that people are desperate to solve? Have you done your homework, even basic market research? Show them you're not just building something cool, you're solving something critical. And a massive piece of this, it's you, the founding team. Your grit, your obsession, your coachability, that's what they're betting on. Don't come in here with a 50-page financial model. It's too early for that noise. What you need is a crystal clear, compelling problem statement. Why does your solution need to exist? Who is your customer and why will they care? Any shred of evidence for market demand, even if it's just a handful of interviews or a simple landing page with sign-ups, is pure gold. This isn't about proving you're the next unicorn overnight. It's about validating that core concept, showing you've got the hustle to figure things out and that the founding team is the one to back. Prove you're the person who will run through walls for this. Okay, you made it through pre-seed. You got a little bit of cash, a little bit of belief. Now it's seed stage. Think of it this way. You planted the seed. Now you got to show it can actually grow into something, not just wither and die. This is where your minimum viable product, your MVP, has to be more than just a concept. It needs to be a living, breathing thing that actual users can interact with. The name of the game here is product market fit. Are people using what you built? Are they finding value? Are they sticking around, or is it crickets? You need to be obsessed with user feedback. This is also where you start building out that initial core team. You can't wear every hat forever, and investors want to see you can attract talent. They're looking for that developed MVP, sure, but what they really want to see is early traction, initial user adoption, customer feedback. The good, the bad, and the ugly show you're listening. And a business plan that's starting to look like a real business, not just a dream. How are you going to acquire customers? What are the early signs of a scalable model? It's about showing those first green shoots of growth, proving there's a real business here. Series A, now we're talking, this is where things get serious. You've proven your concept, you've got some traction, you've shown product market fit. Series A isn't about finding out your business works, it's about scaling what's working. This capital is rocket fuel. It's for building out your operations, making things efficient, seriously expanding your revenue streams and growing that customer base like crazy. Investors here are looking for predictability. They want to see that if they give you X dollars, you can predictably turn it into Y revenue or Z users. You need to have your metrics dialed in. Consistent growth in users, revenue, engagement, or whatever your key performance indicators are, they need to be trending up and to the right hard. Your customer acquisition strategy can't be, we hope people find us. It needs to be a well-oiled machine. Unit economics, how much it costs to acquire a customer versus how much revenue they bring in, have to make sense, and you need a clear, well-defined plan for how you're going to use this money to scale. This is about showing you're ready to move from a promising startup to a serious growth company. Chapter 4. Series B. Dominating the market, going big. Welcome to Series B. If Series A was about scaling, Series B is about dominating. You're no longer just trying to prove you have a business, you're trying to prove you can be a leader in your market. This funding is for rapid expansion, maybe breaking into new geographical markets, significantly developing your product line, or even making strategic acquisitions. The stakes are higher, the numbers are bigger, and investors are looking for a company that's really hitting its stride and has the potential to become a major player. You need to show you're not just growing, but you're building a defensible moat around your business, your key metrics. They need to be substantial and still growing strong. Your competitive positioning needs to be crystal clear. Why are you winning and why will you continue to win? Operational scalability is huge here. Can your systems, processes, and team handle exponential growth without breaking? Investors are also scrutinizing your leadership team. Do you have the experienced executives in place to manage this next level of complexity? And your financial projections need to be robust, believable, and backed by a clear strategy for hitting those ambitious targets. This is about building a significant, sustainable business. All right, folks, we're diving into the late stages now, Series C, D, E. At this point, we're talking about mature, established companies. You're likely a recognized name in your industry, maybe even a market leader. The primary goals here are often significant expansion, maybe acquiring other companies to consolidate your position or enter new verticals. Critically, you're preparing for an exit, either an initial public offering or a major acquisition. The investors coming in at this stage are often different, sometimes private equity firms, and they're looking for a clear path to liquidity and substantial returns. You need to have established market leadership or at least a very strong, defensible position. Revenue numbers are substantial and profitability or a very clear path to it is paramount. Valuations are high, so the growth expectations are still there, but it's also about stability and market dominance. Investors want to see a well-oiled machine, a company that has proven its business model many times over and is now looking to capitalize on its success on a massive scale. The questions are less about if and more about how big and how soon for the exit. All right, let's talk bridge funding. Sometimes things don't perfectly align. Maybe your next big round, like a Series B or C, is taking longer to close than expected. Or you have a specific urgent opportunity before a major event, like an IPO or acquisition, and you need cash now. That's where bridge funding comes in. It's typically a short-term loan designed to bridge that financial gap and keep the lights on, keep the momentum going until that larger financing event happens. It's not growth capital in the same way as a priced round. It's more like a lifeline or a strategic injection. The key criteria here are pretty straightforward. You need to demonstrate a clear, acute need for this short-term capital. Why now? What happens if you don't get it? And crucially, there needs to be a very strong likelihood of securing that future, larger funding round or achieving that exit event. Investors providing bridge loans want to see a clear path to getting their money back, often with a nice return in a relatively short time frame. Sometimes they'll ask for collateral or they'll get a discount on the next round's shares. It's a tactical move, not a foundational one. Last but not least, mezzanine funding. This is a different beast, often for more mature, stable companies that are already profitable. Think of it as a hybrid. It's got elements of both debt and equity, and it's typically unsecured, meaning you're not putting up specific assets as collateral in the traditional sense. Companies use mezzanine financing for major growth initiatives. Think big acquisitions, massive expansion projects, or even management buyouts. It's often less dilutive than a pure equity round at this stage, but more expensive than senior debt because of the higher risk for the lender. What do these lenders look for? Strong, consistent cash flow is king. Your business needs to be a cash-generating machine to service this kind of debt. A proven track record of profitability isn't just nice to have, it's essential. They want to see significant growth potential still ahead of you, even as a mature company. And you better have a highly detailed, super credible plan for how you're going to use these funds and critically how you're going to repay them. Lenders will scrutinize your debt service coverage ratios. Basically, can your profits comfortably cover your debt payments? This is sophisticated financing for big, bold moves. So that's the roadmap from the spark of pre-seed to the strategic growth of mezzanine. This isn't just theory, people. Understanding these stages and their criteria can significantly enhance your funding strategy. It means you know what investors are looking for when they're looking for it, allowing you to build and pitch with precision, not just passion. Stop flying blind and start navigating with a map. This clarity is your power. It allows you to focus on hitting the right milestones at the right times and to articulate your company's value in a way that resonates deeply with investors at each specific phase. It's about being a strategic operator, not just a hopeful entrepreneur. That's what builds the trust and confidence needed to secure capital, to get them to believe in your vision as much as you do. So internalize this, use it. The funding journey is about smart, sequential execution, not luck. Stay tuned for more insights on navigating the venture capital landscape. I'm Vivek Joshi, here to arm you with practical knowledge, the stuff that actually moves the needle. Now go out there and make those informed moves, crush it,